Hey guys, hope you and the families are doing well. I'm going to take you through my swing trade in Tesla from this week, but we're going to go a step further. I'm going to teach you some of the subtleties and some of the nuances to be looking for to better identify institution accumulation. So visually, what does institution accumulation look like? That's what I'm going to be teaching you by understanding the really positive price and volume clues that display on this chart. Now, Tesla was a stock that I was targeting for the December 5th session. So if I click on my session plan there for members, and you can see it is posted at 8 a.m. That's London time, so that's many hours before the US market opens, and I'll show you what I was looking at and why I was targeting Tesla. So it's in the targeted stocks here. Let's click on Tesla so you can see how I was thinking about the chart. Some of these annotations I'll take you through during this YouTube video as well, and then it formed what I call a trigger bar. So you're going to learn about trigger bars, this tightening price action here, how the volume was drying up, how the RS line was subtly turning up as well, the RS 52-week highs, this high relative volume coming through, the earnings gap. You're going to learn about all of that. It's going to be a very thorough, very in-depth video, so I hope you get a lot out of it. Before we get into it, I'll let you know that Market Surge are today's video sponsor. They're my go-to resource for analyzing company fundamentals. If you're interested in a discounted trial, then you'll find a link to that in the description and the comment section below. Okay, so let's get into the video. Now, let me say at the start of this video, this is not going to be vague. This is not going to be fluffy. My brain hates that stuff. This subjectivity, vagueness, where did you buy it? Why did you? I hate all of that stuff, right? This is going to be very specific and very detailed. That is how my brain works. So I'm going to take you through a logical flow here, okay, of how you, one, identify the setup, 2, control the risk, 3, mitigate the risk, and then 4, optimize profits. So whether you are a scalper, an intraday trader, a day trader, a swing trader, or a position trader, there's 4 parts to every single trade. Okay, 4 parts. Every single trade, doesn't matter where you are on that spectrum, from scalper to position trader and everything in between. There's 4 parts to every single trade. What are they? Again, it's identify, it's control, it's mitigate, and it's optimize. So 1, how do you identify a high quality setup? 2, how do you control the risk to create an asymmetric risk versus reward trading opportunity? 3, how do you mitigate the risk to free roll the trade, be break even on the position so then you can't lose any money? And then 4, what are the selling rules and guidelines that you are using to optimize profits, both in terms of size of the monetary gain, but efficiency of the monetary gain? That's the time value element. So identify, control, mitigate, optimize. So that's the logical flow that you go through when you're thinking about trades. So let's start off with the identification. Okay, so we're going to go identify, then we'll talk about how you control the risk, then we'll talk about the risk mitigation, then we'll talk about optimizing profits, so selling rules and selling guidelines. So that's going to be the flow. It's very, very logical. This is how you break down trades. This is how you start realizing that your trading is a skill set. It's a developable, there we go, got there in the end, didn't I? It's a developable skill set. You can get better at identifying trades, identifying really good setups. You can get better at controlling the risk. You can get better at risk mitigation. You can get better at optimizing profits. Okay, it's a skill set that you're constantly trying to evolve and get better at. So let's start off with the identification. Now I'll kind of start over here and then work backwards. So let me give you a little bit of a high level overview. Okay, so the trigger bar. Now a trigger bar for me is often a tight low volume inside bar around 1 or more key daily moving averages. It doesn't have to be an inside bar. Okay, it doesn't have to be. So let me just repeat this. So you see this really tight bar, you actually get a clustering of 3 tight range bars coming in here, okay? And some of you would have read, wouldn't have read because it's YouTube, you would have seen the video on my YouTube channel by Toby Crabell. Now Toby Crabell created the 2 bar and 3 bar NRs and the narrow range 4 and narrow range 7, okay? And his findings were that from periods of contraction come expansion. Okay, from periods of contraction, so price contraction, like you're seeing here, you see how this is a contraction in price. Price is trading in a very tight range for 3 sessions. Yes, there's a little gap, but see the tightness of the 3 daily candlesticks. From periods of contraction come expansion. From periods of expansion come contraction, such as this base, right? You see how Tesla moves up, this is expansion, and then it consolidates, this is contraction, then it moves up, this is expansion. Okay, so stocks, the market, ETFs, Bitcoin, cryptocurrencies move from periods of contraction to expansion and back to contraction and expansion. That is how they ebb and they flow, okay? So you want to be aware of that from identification standpoint if you're looking for chart patterns such as you see here, which is more of a Davis box flag type pattern, okay? So this really tight contraction at the end, I really like it over multiple days. So this here is a trigger bar on December 4th. So this is why I was super duper dialed in, right? As Ella would say, super duper daddy. So super duper dialed in on Tesla for December 5th. Okay, because I was thinking tight period of contraction. This is going to be on a lot of traders' radars, okay? It's awareness of myself as a trader, but awareness of other market participants. Got talking in this video, can I? Awareness of other market participants. So I'm thinking this ain't just going to be on my radar. If Tesla starts breaking through the high of this tight little range, starts coming out of the high of this base as well, a lot of traders, a lot of market operators are going to be looking at this, and we're going to talk about the institutional footprint a little bit earlier on in the chart as well. But trigger bars. That was my ADHD. I've gone over there and I'm like, let me go back over here. So trigger bars, right? Trigger bars are often tight, low volume inside bars around one or more key daily moving averages, but they don't have to be inside bars, okay? But the one or more key daily moving averages where I like looking for trigger bars around is the 10-day EMA, which is going to be the black line on my chart, the 21-day EMA, which is the blue line, and then you have the purple line is the 50-day simple period moving average, and the gray line is going to be the 65-day EMA. So I'm not looking for necessarily a trigger bar like here. You may be like, this is a really tight bar, is it? No, it's short-term extended. It looks like it wants to pull into the 10-day. It's just not, okay? It's just not. Just don't even go there, okay? It's over here. This right here, this is the spot to buy. Right there. I was also trying it through the high of this bar here, and there was a nice shakeout there going on with Tesla as well. But hit through the high of this bar was pretty good, but it gapped and I didn't get filled using a buy stop limit order. But yeah, over here. Anyway, so I digress. So trigger bars, really look for those periods of contraction, especially if you see it in a leading stock like Tesla was. How do you know it's leading? I got a free tool on TradingView. Search my name in the indicators. You'll find it called the relative strength line. Now you'll see these 52-week highs. What do these 52-week highs mean? That means it is hitting a 52-week high on the relative strength line versus the S&P 500. Tesla is showing a lot of relative strength versus the major indexes. Guess what? The really smart money, the really good operators in the market, they want to be where the relative strength is, because the relative strength is showing outperformance. So how do you outperform the indexes? Well, you tend, if you're more so a fund manager, or have a significant amount of assets under management and you're running funds or you're running this or that or a hedge fund, okay, you want to be where the leadership is. You really want to be in the outperformance. Why? Because if you can then outperform your benchmark, which oftentimes is the S&P 500, you're going to get more assets under management. If you're underperforming your benchmark, people go, you're no good at this, I'm going to go someplace else. Then they lose assets under management. So the really savvy operators in the market will go where the relative strength is. Okay, they want to be where the relative strength is. And you're seeing some of that in here around the earnings. You're seeing some of that in here as well. You're then seeing it in terms of this accumulation base being this flagged harvest box type pattern. Okay, so let's then rewind a little bit. So what we have is we have Tesla really tightening up here. So my entry is here, initial stop loss is here. We'll come on to that a little bit later. We've got RS 52-week highs in the base. Really, really like that in the base. Look how this RS line is turning up as well. Okay, really like that. Upticks in the relative strength line. 52-week highs coming through. Even better if it's 52-week highs in the base. Okay. Then another thing that we're trying to do is spot institution accumulation. Okay, so institutional accumulation, you kind of visually want to learn that. So what is it? What does it look like? Well, let's go take a look at the earnings bar. And I'm going to bring up a calculator, okay? So Tesla on its earnings day, okay, trades 204 million shares. Okay, 204 million shares. That's the volume coming through. And then if we just took an average price of 250 on the earnings day, I'm going to explain the dollar volume point here, okay? So if we take 204 million shares are traded on the earnings gap up, this bar right here, okay, that we're talking about. And if we times that by an average price of 250, okay, around 250, it may be maybe a little bit higher, like 251 or something, but just an average, right? Okay, on the earnings gap up, there's 204 million shares traded at an average price that we're calling $250. The dollar volume, so times the amount of shares by the rough average price, the dollar volume on the earnings gap up is $51 billion. That's not retail traders on Wall Street Bets or Reddit doing that. It's not them. They don't have that level of buying power and then sustained buying power that you're going to see afterwards. $51 billion worth of stock exchange hands. That's the bigger boys and girls. Now, the fact that it's on the earnings reaction as well, this is where you build out your mental representations and go, there's $51 billion worth of stock exchange hands, roughly, okay, on the earnings gap up. What are the bigger boys and girls doing? What does it look like they're doing to you? Are they buying? Are they accumulating? Or are they selling into it? They're buying, and they're buying a lot. And then the next day, it pushes up again. See that? Post earnings pushes up again. Now what you have here is it's pushed, and it's probably going to pull back in to its 10-day, 21-day EMA region. Okay, so following an earnings gap, watch for the pullback into the 10-day being the black line and the 21-day being the blue line. Okay, now a little subtlety here. Okay, so I said I was going to go into the nuances. Here's one of the nuances. Watch where the stock finds support. does it find support around its 21-day EMA or 10-day EMA post-earnings gap? If it does and then moves higher, that is usually a good sign the bigger boys and girls are in there supporting the stock around a region, being a key daily moving average, the 21-day EMA in this instance, that they are supporting the stock. Check. Okay, so what you then have, this is where you build out your mental representations. You're following the footprints of institutions. Okay, so we're going to go from here all the way over here, and you'll see the logical flow. I don't know what I was doing in the beginning. I was over here somewhere, right? We're back over here. Okay, so what we have is we have the positive earnings reaction on huge volume, pushes up the next day as well. It's not just a gap and fade, pushes up the next day. Great. Okay, and then it pulls back in, it finds support around a key daily moving average where we would expect institutions to step up and support the stock. 21-day EMA, check, we're seeing that. Also undercuts the low of the earnings gap up. So imagine if you were kind of chasing the ORB here, not necessarily chasing, it was kind of an okay ORB actually. I bought it myself actually. Over here. It was a good one, but I then went low of the day like this. I thought a high probability of a pullback, and I thought that's a good way to optimize profits on that one. So I was buying this in terms of the opening range breakout on the earnings gap. But what then happens is the low of this little shakeout demand tail on this doji bar undercuts the earnings gap. Ooh. Shake them out. Shake them out. A lot of traders would have placed their stop loss where? Low of the day on the earnings gap, and they just got shaken out. Even better. Okay, then what happens is you get the US election result. Now we all know that Trump and Elon Musk are buddy right throughout the election. Whether you think that's good, bad, indifferent, I don't care, you don't care, so let's not go political in this video. But how does Tesla react on the US election result? Does it react favorably? Does it react not favorably? Unfavorably, we'll call that. What do you think? Or what do you see? Look at this, it gaps up again, and you get a shakeout demand tail, strong close. Gaps up, clears this little range in here as well. Gap up, opens here, shakes out during the session, pushes up, strong close. Look at the volume coming through again. This ain't Wall Street bets. This is not Reddit. These are the bigger boys and girls. And then what happens in coming sessions? This drives up even more. If we were going to go take a dollar volume reading on this bar here where I say bullish synchronicity, that's where there's a synchronicity between positive price action and high relative volume coming through. So it trades, again, 204 million shares. The dollar volume is going to be even higher on this one. And if we take an average price, I'm just going middle bar 310, so times that by $310, the dollar volume is 63 billion. Okay, $63 billion worth of stock exchange hands. So over here on the earnings gap, we had about 50 billion. Here, we've got around about 60 billion, okay? There's $110 billion worth of stock exchange hands on the earnings bar and this bullish synchronicity bar. What are the bigger boys and girls doing? They're buying. This is visually what institution accumulation looks like. This is what you need to build out your mental representations for, to recognize this and go, wow, that is what it looks like when institutions are buying a shed load. They can't get enough of it. They want it, they want it, they want it. And then what we're going to do is look how Tesla base, look how it bases, okay? Bases, not the word. Look how the base unfolds. There we go, I got that. Look how the base unfolds, okay? So it develops into a Davis box flag. Maybe you kind of, oh, it's a VCP, right? Look at this, you get one contraction, two contraction, high low, three contraction, another high low. It's VCP action, and it's a flag, it's a whatever you want to call it. It's a really, really nice continuation type base. Now, the strongest stocks when they are basing, okay, so we're looking for the nuances, we're looking for the subtleties. The strongest stocks when they are basing will find support around the 10-day EMA. 10-day EMA. That is the black line on my chart. Bounced pretty much off the 10-day. Here, little undercut, but holds around the 10-day EMA. Here, holds just above the 10-day EMA. Bounce here, holds above here. Tightens into the 10, and look how the volume dries up. Okay, so as this base starts developing, note what's happening with the volume. So you get higher lows, structural higher lows are very, very bullish to see, certainly in the leading stock hitting 52-week highs. Look at the volume. Tailing off, tailing off, tailing off, tailing off. The volume is drying up from left to right. This is, again, a classic kind of characteristic that you'll see from optimal continuation bases. Certainly, if this happens, Everything we've spoken about, the earnings gap up, the US election result, the price and volume action that you were seeing on the US earnings, US election result, and then the pushing up there afterwards. And then the fact that volume is drying up in the base. This is saying there is less and less supply that is coming to the market for this stock, and institutions, to my mind, are just in there absorbing the supply. We're just going to soak it up, We're not going to buy everything at once. We're going to take our time here, take a couple of weeks, take a month, build our positions. Okay, price is pulling down, we're just going to start stepping back up. Price pulls down again, okay, we're just going to step up, we're going to soak up the supply. And then there's less and less and less supply. You then get that period of contraction, both on a 3-day basis, a 1-day basis, and also a kind of 3-week basis, maybe a little bit more. How long is that base? Around about 4 weeks or so. So you have this period of contraction over 4 weeks, you have it over 3 days, and you have it over a single session, given the tightness of that bar. So your periods of contraction that then lead to expansion can happen over days, multiple days, weeks, months as well. Okay, so contraction can happen over multiple durations. So that is then how we kind of get to this point here. So then what I looking for, if you watch the channel for a while, trigger bars, shakeout demand tails, gap down reversal bars, okay, for these kind of swing trading setups. So there you get a trigger bar, as I was talking about earlier. So then what I'm doing, then the identification and the trigger bar low relative volume, and see how the volume is subtly just stair step down, stair step down, stair step down. We like that, okay? And the RS line is just ticked up here a little bit too. Just another little nuance there, okay? So that's the identification. Then we get into the controlling risk. So with a buy stop limit order, I'm targeting it through the high of the trigger bar, stop loss sent underneath the low of the trigger bar, like I was showing you in the session plan at the start of this video, okay? So I'm looking to target it through the high. Now I get a little bit of slippage, there's a little gap up as well, so I get a little bit of slippage in there, okay? So still within 0.5% of the prior day's high. That's invariably what I do with a buy stop limit order, 0.5% for the limit above the prior session's high, which will often be a trigger bar, a shakeout demand tail, or a gap down reverse bar if I'm using the order entry method technique of buy stop limit orders, okay? So when I'm planning the trade out, and you can see, so this is my initial stop. It would have been a little bit tighter by about 0.45% or so. I was kind of planning it out, but because of the little gap, I get filled a little bit higher, okay? But even though here, 3.14%, take a look at the 20-day ADR percentage, which is up here, okay? It is 5.11%. So I like to think about initial risk relative to the 20-day ADR percentage. Now, the 20-day ADR percentage, if you're not familiar with that, is the 20-day average daily range percentage of the stock, excluding gaps. So the daily range percentage of Tesla over the last 20 days, excluding gaps, is 5.11%. That is how much Tesla wiggles and jiggles over the last 20 days on average. If you want to find that, just search ADR percentage in the TradingView indicators, and I used one by Amish Lookler. There's loads of them, okay? Just search ADR percentage, you'll find it. Use a little bit kind of self-sufficiency, guys, come on, okay? 20-day ADR percentage. So what I then do is think about the initial risk and my planned initial risk. That's why I like the buy stop limit order here, okay? So I'm planning it out ahead of time. I know what my maximum risk is going to be because I've determined the limit on the buy stop limit order. I know that it's 0.5% above the height of this bar. So if I get filled at the maximum amount that I'm willing to pay for any shares, which is the limit, okay, and my initial stop loss is a cent below the low of this trigger bar, then I know my max risk ahead of time. So I can already then calculate what is my max risk going to be relative to the 20-day ADR percentage. So in this instance here, the 20-day ADR percentage is 5.11%. My max risk on the trade, let's just say it's 3.14%. That's what it then turned out to be here in terms of my actual initial stop loss, where I was then filled on the position at 35988. Initial stop loss at 348.59 is 3.14%. I like to look at it as a metric relative to the 20-day ADR percentage, and ideally it's half to 2/3. Okay, half to 2/3. So here it's just over half, but it's under 2/3, right? So it's in that region of kind of half to 2/3. Nice, like that. If you're going to target, so you'll hear me talk about shakeout demand tails and gap down reverse bars, those bars inherently are wider. So the initial stop loss will be a little bit wider, potentially closer to the 20-day average daily range percentage. But with trigger bars, often in the better instances, as you're seeing here with Tesla, it's a very good setup for me. It's probably 9 out of 10. Tesla here in terms of this base, maybe 9.5 actually. It's a really good setup in my view. Half to 2/3 for trigger bars, really tight bars. So that there, because if you're trading a stock, let's say that has a 20-day ADR percentage of 3%, well, the optimal trigger bars, you're not going to have a 3% initial stop loss. It'd be more so like 1.5%, maybe 1.8%, maybe up to 2%, something like that. Kind of 1 to 2% range could be really nice. If you're trading a proper momentum leader type stock and it's got an ADR of, let's say 10%, 12%, 15%, you're probably not going to get it with a 3% initial stop on a trigger bar. Actually, the trigger bar may be 5%, 6%, just because of the range of the stock. So you want to think about the volatility of the stock, and I think the best way to do that is 20-day average daily range percentage. Works for my brain anyway, okay? So then that's the initial risk planned relative to the 20-day ADR percentage. In terms of the mitigation and the optimizing profits, I'm not going to talk about that too much in this video, because this video is already, I can't talk in this video. This video is already pretty long. But if you're interested in that, there's stuff on the platform about it and things like that, okay? But the risk mitigation, it's all covered in the blueprint video for free on YouTube as well. Thinking about taking half off at 1 times the initial stop loss, potentially a third off at 2 times the initial stop loss, potentially active risk mitigation. And then in terms of optimizing profits, what I think is, I'll talk about that a little bit. I like to use trailing stops. Now, the 2 most common moving averages that I use as trailing stops that I'll be looking to use here on Tesla is the 10-day EMA, which is the black line, okay, as a trailing stop. So looking for a close below that to potentially exit the position. Again, it's not so much a selling rule, it's more of a guideline. And then seeing, okay, how is price acting around there? Because on this bar here, for instance, well, it does actually close below the 10-day, just right, but actually it's a little shakeout. So on this day here, if I had a position, let's say here, if I had a position here, okay, coming through on this bar here, so say I'm like buying it in here, right? If I was going to go, right, I'm going to hold this till it closes below the 10-day. Well, it does close below the 10-day on that bar, right? It does close below it. But do I want to exit the position? Well, actually, Tesla is pretty strong. It's basing here. So a more optimal thing to do in that instance may be actually stagger the stop and go, I'll keep part a little bit lower here, just see how this kind of plays out for the next couple of sessions. And I'll put part on the low of the bar. If it starts taking out the low of the bar, okay, then I'll exit, but I'll give it a chance to bounce and turn around, which is what you can then see Tesla did there. So again, it's more kind of rules and guidelines. It's more ebb towards guidelines. Okay, how does price react around that? So 10-day EMA, 21-day EMA is one that I use as well, but Tesla has a history of getting short-term extended from the 10-day EMA. So in that instance, what I did here on the earnings gap up, okay, I went low of the day for the initial stop and then low of the day, low of the day. Now the reason that I did that, it didn't turn into a huge, there was actually some overhead resistance up at this level that you can't see. It's left on the chart over there from a little bit earlier on in October and September. But here, for instance, if you bought the gap up on the US election result, okay, something that I like doing, so imagine you buy it there, you place your stop loss on the low day and you're in here somewhere, okay? What I then like doing is if a stock gets extended from the 10-day EMA, as Tesla does here, just move my stop to low of the daily low, low of the daily low, low of the daily low. Now in that instance, you're going to be taken out up here somewhere, okay? So just low of the day, low of the day, low of the day, and then you're taken out here somewhere. If price gets short-term extended and is climactic away from the 10-day EMA, there's always a selling rule guideline that I keep. So low of the day, low of the day, low of the day, all trying to trail 10-day EMAs, 21-day EMAs, and often it's a combination of things, okay? It's not the extreme over here, it's not the extreme over here. It's usually somewhere in the middle is the most practical and logical thing to do and helps optimize profit. So anyway, that video is way too long, but hopefully you've enjoyed it. You've learned something about how to think about the trade, a methodology as well to start thinking through, or a framework to start thinking through of identify, control, mitigate, and optimize. Whether you're a scalper, an intraday trader, a swing trader, a position trader, it is all about how do you identify, how do you control, how do you mitigate, how do you optimize. It's a really useful framework to start thinking about your trades through. So thank you very much for watching that very long video now, and I will see you in a future one.